Good afternoon. Jeremiah Conger here from Annuity Association, and I'm very excited to be bringing back another exciting, unbiased annuity review. Today we're going to be discussing a fairly new fixed indexed annuity offering that specializes in guaranteed lifetime income, both single and joint benefit, and it has some unique features to this annuity that can help cover the cost of long-term cares. Long-term care cost is one of the major risks that retirements face today. And you're starting to see some of these fixed indexed annuity options on the market that are designed to address not only an income need for retirement, but also planning for those unexpected long-term care costs should they arise. So we're starting to see some really nice innovation in the independent annuity marketplace that's helping us address multiple risks when it comes to retirement planning, and really excited to bring this annuity review to you today. The product that we're going to be discussing is the Investors Heritage Income Advantage. Again, this is a fixed indexed annuity structured and designed for lifetime income, as well as covering long-term care costs should they arise. So before we get started, just want to say thank you for tuning in. If this is the first time that you're watching our reviews, I really want to really hone in on what the mission and primary objective is of our company, Annuity Association, and that is to bring more transparency to the annuity buying process to ultimately help you as an end consumer make an educated decision on whether or not an annuity is right for you, and if so, which products specifically or combination of products is going to help you address your needs, goals, and objectives in retirement. For those new to myself, I am an independent annuity advisor. I'm not tied to one company or one product. My job and mission is to help you understand all of the available products on the marketplace today to help you make that educated decision with confidence that those products are going to help you meet your needs, goals, and objectives. So if you'd like to work with me directly, I work with clients in all 50 states. I'd be honored to have that opportunity. You can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report. You'll be taken to a series of opt-in questions, one of those being, would you like to be contacted by an advisor? Simply answer yes, leave your phone number, of course, and I will personally reach out to you in a timely fashion to see how I can help point you in the right direction. So, okay, before we get started, I'm going to go ahead and dive into our handy dandy brochure, or disclaimer, and then we'll be diving into the brochure. So let's go ahead and take a look at this. Again, we are talking about the Investors Heritage Income Advantage Fixed Indexed Annuity. This is an independent review, unbiased, brought to you by AnnuityAssociation.com. This is a review, not a recommendation to buy or sell an annuity. Investors Heritage has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional. Excuse me, I realized I wasn't sharing my screen. Let me go ahead and start that over. I'll lead off, start where I left off here. Be sure to consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness and or accuracy. So as you can tell, this is a live review. And unfortunately, with a live review, we don't have a way to edit or revise any of these bloopers, if you will. So from time to time, I will make mistakes here and there. There have been a few reviews I've done in the past where I realized my microphone was muted, so I had to completely redo those. So I do double check my mic 2 or 3 times before I start, and it just goes to show you I'm not a professional spokesperson or production person and whatsoever. Just an annuity advisor, an annuity geek, annuity nerd, just trying to bring more transparency to these products for you out there. So if this is the first time you're watching a review, some of the things we'll cover is we will dive into the product brochure. We'll discuss the features and benefits, really break this annuity down so that you can have a thorough understanding of all of the features and benefits available to you and how those different things work. And then later on in the review, we'll be taking a look at at our software where we'll take a deeper dive and breaking down the available index crediting strategies offered in this particular annuity to see how they've performed over the last 10, 15, and 20 years, hypothetically. And it really gives us an understanding of what these index strategies can do. And it gives us a very, I think, good starting foundation in terms of which index strategies we should consider allocating our monies to. And then last but not least, because this is an income-focused annuity, we will be taking a look at our income calculator as well as a sample illustration to help you understand the logistics or mechanics of this annuity and break it down just another level further so that you can get a very good understanding of how the income components work. So without further ado, I'm going to go ahead and share my screen again, and we'll dive into the brochure. So again, we're talking about the Heritage Income Advantage fixed indexed annuity. And let's get started. So plan your dream retirement. Dreaming about your retirement can be exciting, but it requires more than just dreaming. It requires thoughtful planning as well. We recommend you have detailed conversations with your financial professional about your goals and consider these questions. Have I saved enough? Can I grow my assets and protect them from market volatility? How much income can I reasonably expect to have in retirement? And when can I access my money? Here is the fixed indexed annuity explained for those not familiar with a fixed indexed annuity. It is a tax-deferred savings vehicle designed to grow your retirement savings and provide protection from market downturns. Fixed indexed refers to the options available for growth. You can distribute your funds among different accounts. The fixed interest rate account, accounts based on the performance of several market indices, or a combination of both fixed and indexed accounts. An indexed annuity, a fixed indexed annuity, is protected from market downturns because it is an insurance contract, not a direct investment in the stock market. Unlike a direct investment, a fixed indexed annuity guarantees the fixed indexed account will provide a minimum guaranteed interest rate that will be credited to your account value. With the index accounts, your crediting rate is guaranteed never to be less than zero, even if the index you've chosen goes down. All right. Let's talk about the retirement advantage. Heritage Income Advantage is a single premium, deferred, fixed indexed annuity designed to protect your assets from market downturns and grow your retirement savings. The optional guaranteed lifetime withdrawal benefit rider can provide a guaranteed income stream that you can't outlive, and the ability to double your income for certain qualifying conditions. Here we provide an overview of our Heritage Income Advantage and how it can fit into your overall retirement plan. Your financial professional can provide more information and answer any questions you may have. Get to know the benefits. Your funds are safe from market downturns, and you can immediately grow your funds with a premium bonus. It includes a guaranteed minimum interest rate, tax-deferred growth, access to your funds with penalty-free withdrawal options. An optional rider provides a guaranteed lifetime income stream and a guaranteed double income for up to 5 years for certain qualifying medical conditions. And your advantage starts here. The Heritage Income Advantage is a single premium fixed indexed annuity, meaning you purchase the annuity with one payment. It can be purchased for as little as $25,000 and up to $1 million. It is available for both qualified and non-qualified accounts and for ages between 18 and 80 years young, and is available for single or joint ownership. And it includes a retirement income stream. The optional guaranteed lifetime withdrawal benefit rider is available at purchase for those ages 55 to 80. The guaranteed lifetime withdrawal benefit rider provides a guaranteed lifetime income stream and also includes the enhanced income benefit rider, which is guaranteed to double your lifetime annual income for up to 5 years for certain qualifying medical conditions, even if your account value is zero. You also have the ability for immediate growth. The Heritage Income Advantage includes a premium bonus, which we'll be covering here in just a moment to see how much that bonus is at the time of this review. And that immediately increases your contract value. The premium bonus is added at issue and is available for allocation in your crediting strategy. If you include the guaranteed lifetime withdrawal benefit with your contract, you'll also receive a benefit-based bonus at issue. The benefit base is used to calculate your lifetime annual income. And flexibility when you need it. The Heritage Income Advantage provides access to your funds with several penalty-free withdrawal options, including required minimum distributions, 10% annual contract value withdrawal, and a nursing home waiver. So let's break down this guaranteed lifetime withdrawal benefit rider. The guaranteed income is the optional guaranteed lifetime withdrawal benefit rider designed to enhance your retirement by providing a guaranteed income stream with lifetime annual income. You can choose to take your income for your life, which is single income, or the life of you and your spouse, which would be structured joint income. The guaranteed lifetime withdrawal benefit is available at the time of application for Heritage Income Advantage for those ages 55 to 80. And the lifetime annual income amount is fully guaranteed to be paid each year, regardless of underlying account value performance. Your guaranteed income stream can be turned on after the first contract year for those age 56 and above. A rider fee of 1.25% is charged for this benefit and as a percentage of your benefit base and is deducted annually from your account value. So let's break down what exactly the benefit base is. The benefit base is the amount used solely to determine your lifetime annual income. Your benefit base at issue is equal to your single premium plus a benefit bonus of 8% of that premium. The benefit base grows each year by a roll-up rate of 7%, compounded on each contract anniversary during the roll-up period. The roll-up period is the earliest of 10 years, the income start date, or the date the oldest owner or annuitant, if non-natural owner, turns 85. The roll-up rate is declared at contract issue and guaranteed not to change for that contract. Your lifetime annual income is calculated based on several factors: your benefit base and age at income election, and the single or joint income lifetime withdrawal rate. The lifetime withdrawal rate is set at income election and based on your age or the age of the youngest spouse if taking joint income. You cannot take withdrawals from or surrender the benefit base. The benefit base and benefit base bonus are not included in the account cash value or death benefit calculations. Okay, so that was a pretty good breakdown of what the benefit base is. The Investors Heritage did a really good job on explaining that. A lot of times in these product brochures, that isn't really broken down in that thorough of a manner. But to take it a step further, one of the exercises that I use with my clients or prospective clients to explain, how these indexed annuities work with lifetime income riders is I have them take out a piece of paper. And on that piece of paper, I have them draw a large capital T or a T chart. And the key thing to note here is that an indexed annuity with a lifetime income rider has two accounts, two columns, if you will, of value that are used for different purposes of the product. So for example, on that T chart, at the top right-hand side of your T, you're going to write benefit base or income value. Those are the same thing. Some companies say income value, some say benefit base, some say income benefit base. But either way, in this case, put benefit base at the top right-hand side of the T chart. On the left-hand side of the T chart, you're going to look at that and draw account value at the top left-hand side of the T chart. And so down the columns of the T, the right-hand side of your T chart grows according to the contract of the lifetime income rider, or in this case referred to as the guaranteed lifetime withdrawal benefit rider. And in that contract, it will state the roll-up rate, which in this case on this product, it's 7%. Now, what roll-up rate means is it's basically an interest rate that they use that's compounded every year that you defer turning on the income stream. So let's think about putting in as a hypothetical example, let's say we're putting in $100,000. That $100,000 is going to come into the T chart. It's going to go right into the first column under account value, and then also over to the right-hand side of the T chart for the benefit base. Now, if the benefit base has a bonus, which in this product it does, that $100,000 will receive an 8% bonus on the right-hand side of the T chart. So year one, the first line item under the T chart on the right-hand column, that's going to start at $108,000. Not $100,000, but 8% bonus being applied. It'll start at $108,000. On the left-hand side of the T chart, this product includes a 2% bonus on the account value. So day one, contract year one, that $100,000 is going to start at $102,000 on the left-hand side of the T chart. So your T in this product at this time should show account value $102,000, benefit base $108,000. Again, going back to the right-hand side of the T chart, each year that you defer income, meaning you're going to wait until you turn the income stream on. Maybe you wait 5 years, maybe you wait 7 years, maybe you wait 2 years, whatever the case may be. Every year of deferral, that income benefit base amount that's at $108,000 right now, year one, is going to grow by the 7% roll-up rate, which is an interest rate compounded. So every year you defer it, it's going to grow 7% a year compounded every year. That is how your income benefit base grows to determine how much lifetime income you receive. And then the last component of that equation, of that formula, is what's called the payout rate. And the payout rate is based on whether or not it's single or joint life, and if joint life or single life, what age we turn on the income. Some products will have the payout rate that increases annually every year that you wait to turn on income. But once you turn on income, whatever that payout rate is at that age, it locks in that payout rate moving forward. Some other products out there include a 5-year step up in the payout rate. Every 5 years of deferral, that payout rate may go up 1% or 50 basis points, 0.5%. And we'll be taking a look at the specific payout rates of this product here momentarily when we go into our software, but really just wanted to break down that T-chart exercise so that you can understand the benefit base versus the account value. The benefit base is not a withdrawable amount in a form of a lump sum. It's only used to calculate your lifetime annual income. The account value is withdrawable. If you're within the first 10 years of surrender, there is a penalty that could be applied or will be applied if you withdraw early. But after 10 years, if you decided, hey, you know what, I don't need lifetime income, I just want to take my account value out and do something else, you would be able to do that. But that's the account value that you can withdraw. You cannot withdraw the benefit base. The benefit base would be foregone if you withdrew all of your money out of the account value. So, okay, thanks for that attention there. I hope that I was able to break that down a little bit more simpler for you. So let's talk about the enhanced income benefit rider. For no additional cost, the guaranteed lifetime withdrawal benefit includes the added protection of the enhanced income benefit rider. The enhanced income benefit doubles your guaranteed maximum income amount if you are unable to perform 2 of the 6 activities of daily living, what's also referred to as ADLs. The enhanced income benefit can be stopped and started again for a total of 5 years. This benefit is guaranteed even if the account value is 0. This benefit is available upon qualification after the second contract year, and the enhanced income benefit is available for either spouse when taking joint income. There are no health questions to answer at the time of application for the Heritage Income Advantage, and upon initial request for the enhanced income payment, the covered person must certify that they were able to perform all 6 activities of daily living at the time of the contract purchase. They must also provide a written statement from a physician that they meet the enhanced income benefit criteria. The company may request annual recertification of this health status, and the 6 activities of daily living are eating, bathing, dressing, toileting, transferring, which is also walking, and continence. Okay, so this is a really innovative product offering a very competitive guaranteed lifetime income opportunity, as well as enhanced income benefits to cover the cost of long-term care. So let's go ahead and continue on. Got some nice photographs here of people planning retirement. Okay, calculated results. So here's an example. So they're going to basically break down what we broke down in our T-chart, but let's go ahead and take a deeper dive into their example here. So let's assume you've purchased a Heritage Income Advantage contract and guaranteed lifetime withdrawal benefit with a $250,000 premium, and it includes an 8% benefit-based bonus, 7% roll-up rate, and 5.5% single income lifetime withdrawal rate. No withdrawals have been made from your account value, and you choose to initiate your lifetime annual income after the second contract year. With these assumptions, your lifetime annual income would be $17,001.77. Your lifetime annual income is guaranteed for life, even if your account value falls to zero after starting your income payments. Should you have a qualifying event with the enhanced income benefit rider, your lifetime annual income would be $34,003.54. So right there, you're seeing them double the guaranteed lifetime annual income to cover the cost of long-term or confined care. So here's the breakdown at issue: $250,000 in investment premium going in, those dollars getting a $20,000 benefit-based bonus, and bringing the total benefit base starting year one to $270,000. And then you're seeing the roll-up rate of 7% and the lifetime withdrawal rate at the time the person has elected to turn on income of 5.5%. So they're showing year one. After year one, the $270,000 is growing by the 7% guaranteed roll-up rate, crediting a total of $18,900 in roll-up benefit to the benefit base. So that brings the total benefit base after contract year one to $288,900. And then starting year two, that new benefit base amount of $288,900, again growing by the 7% compounded roll-up rate, crediting another $20,223, bringing the total benefit base amount at the end of contract year two to $309,123. Then they're giving the example that the person's electing to turn on lifetime income after year two. And so that would take the $309,123 of income benefit base multiplied by the 5.5% single income lifetime withdrawal rate, or what I refer to as the payout rate, bringing the annual income to a lifetime annual income amount of $17,001.77. And then showing you the enhanced income benefit for long-term care, which would double the $17,000 to $34,003.54. So great breakdown there. Really appreciate this brochure. It's very, very thorough. So let's discuss how to access your funds. A fixed indexed annuity is purchased as a part of your retirement strategy, but offers flexibility should you need access to your funds sooner than you expected, or to satisfy required minimum distributions. The Heritage Income Advantage includes a variety of ways to access your funds. Free withdrawals. So 10% of the beginning of year account value is available penalty-free after the first contract year. And free withdrawals are taken from the fixed account unless otherwise specified by the owner. If any withdrawal is not fully paid from the fixed account, the unpaid portion will be deducted pro rata from the account value held in all index accounts with the same term, starting with the shortest term index accounts. Withdrawals over 10% during the first 10 contract years are subject to withdrawal charges, bonus recapture, and market value adjustments. So for required minimum distributions, they can be taken penalty-free after the first 6 months. And the Heritage Income Advantage is RMD friendly. The amount the IRS requires you to withdraw annually after age 72 or 70 and a half if you reach that before January 1st of 2020 is always available without fee, even if it exceeds your annual free withdrawal amount. This applies to qualified accounts only. required minimum distributions may be scheduled for systematic withdrawal to be taken automatically on an annual, semi-annual, quarterly, or monthly basis. There is a $100 minimum for systematic withdrawals, and they must be paid by electronic transfer. So if you have an IRA, 401k, or other qualified account, and you're looking to invest those dollars into the annuity, you can definitely do that. And if it comes down to needing to meet your required minimum distributions, you can use the qualified dollars in the annuity to meet those obligations to the IRS and do so without any penalties, even if the withdrawal is higher than the 10% free withdrawal provision found in this product. So let's talk about the nursing home waiver. So one of the biggest misconceptions about annuities out there is that if you buy one, you're tying up your money with no liquidity for emergencies, especially for, healthcare or nursing home needs. And that's completely false. Majority of these annuities, if not all of them, depending on the state, which most of this is state required now, include what's called a nursing home waiver or a confined care waiver. And that means in the event you have an event that requires nursing home care, you can access a portion of your monies with no penalties. In this particular product, it's up to 50% of the account value is available penalty-free after the first contract year. If on a physician's written recommendation, you are confined to a nursing home for 90 consecutive days or more, after the first contract year, you can withdraw up to 50% of your account value without any fees. This benefit is not available if the annuitant was confined to a nursing home when the policy was issued. See contract for additional nursing home waiver requirements. And we have the withdrawal benefits applied to a settlement option. The full account value can be annuitized without withdrawal charges, bonus recapture, or market value adjustments after the first contract year if the settlement option chosen is for at least 10 years or the lifetime of the annuitant and the annuitant is not older than 80 years of age. Contract cash value net of withdrawal charges, bonus recapture, and market value adjustments can be applied to an annuitization option at any time. So every annuity, whether it be fixed indexed annuity, variable annuity, whatever type of annuity it is, the word annuity means lifetime income stream or income stream. And every annuity has the ability, whether or not it includes a lifetime income rider, to convert the account value to a lifetime or period certain income stream. And that process, or that terminology for that process, is called annuitization. Annuitization means you're giving up control over the account value in exchange for a income stream. That income stream can be lifetime income, single or joint, or period certain, 10 years, 15 years, 20 years of income. And basically every annuity will have what's called an annuitization schedule. It is a completely optional, not mandatory feature. So if you decide, hey, the account value is this, I want to see how much it would convert to an annuitized income stream. Every annuity will have a schedule of what the annuitization income options would be based on your age at the time of election. So very rarely used these days, but still an option if you're interested in pursuing it. Because of this product having a lifetime income rider, most of the time the lifetime income rider will be more beneficial because you're not giving up control over the account value in exchange for the lifetime income withdrawal. Hope that makes sense. And cash value, you may surrender your contract at any time. The amount payable is the greater of the account value, less any withdrawal charges, bonus recapture, market value adjustments, and any premium tax applicable or the minimum guaranteed cash value. Death benefits. So another misconception of annuities is that if you die, the insurance company keeps your money. Entirely false. There's only one type of annuity structured in one type of way that would ever be the scenario. Most annuities today, especially fixed indexed annuities, they do have a death benefit. And if you should pass away and there's still money in the account value, that will translate to the death benefit, and your designated beneficiaries will receive 100% of the account value in the form of a death benefit. So the death benefit is payable to the beneficiary in one lump sum upon the death of an annuitant or owner. The death benefit is equal to the greater of the account value or the minimum guaranteed cash surrender value. Optionally, if the sole primary beneficiary is your legal spouse, the beneficiary can choose to continue the contract as the new owner. With the guaranteed lifetime withdrawal benefit, continuation options will vary if death occurs before or after the income start date. So what that means is if you had a spouse that's set up as joint annuitant on this account, they would have the option to continue the income stream if you passed away, or they could elect to take the lump sum of money that's in the account value. They will have the option to do either or. So let's talk about the withdrawal charges. If you withdraw more than your free withdrawal amount during the first 10 contract years, a withdrawal charge will be deducted from that amount. The charge decreases or stays level each year the contract is in force, and the withdrawal charge percentage is applied only to the amount in excess of the free withdrawal. The withdrawal charge schedule for all states except California is shown below. Please see Form HIA-CA-FEE for California charges. So we'll see the withdrawal charges apply start in year 1, 9.3%, and then at the end of 10 years, it dwindles down all the way to 1%. You got to really understand why the withdrawal charges exist, because of the features and benefits of principal protection, contractually guaranteed that your money can never go down due to market losses. In order for the insurance companies to design these products and offer those types of benefits, they have to know that you're going to keep your money in the account for a period of time. And in this case, it's 10 years. That's how they can make everything work. So you're signing a commitment to keep your money in there for at least 10 years. And more than likely, if you're buying this type of product, you're probably getting the lifetime income rider, which is a long-term planning tool. So chances are you won't, plan on exiting anytime within that 10 years, except in the event that you had a change of heart or an emergency that you just need the additional liquidity. But you should also be planning for those additional liquidity needs and not putting it into the annuity if you do plan to potentially need more money for a rainy day event. And of course, because the product does offer a bonus, if you do decide to exit early, there is a bonus recapture schedule. During the first 10 contract years, the premium bonus will be recaptured according to the following schedule for full surrenders and non-free withdrawals. The premium bonus recapture fees for all states except California again. And we'll see the bonus recapture starts at 100% in year 1 and goes down to 10% year 10. Market value adjustment may apply to withdrawals over the free withdrawal options during the first 10 policy years and to certain annuitization options. The market value adjustment is based on the change in the Bloomberg Barclays U.S. Intermediate Corporate Bond Index yield from the close of business on the day prior to your contract being issued and the close of business the day prior to your withdrawal. The market value may be a credit, increasing your withdrawal amount, or a fee, decreasing your withdrawal amount. Due to the mechanics of a market value adjustment, surrender values generally decrease as the index yield rises or remains constant. When the index yield decreases enough over time, the surrender value generally increases. Even with a negative market value adjustment, you will never receive less than the guaranteed minimum cash value. So market value adjustments, not to get too far in the weeds, but they're just a protected, it's a protective clause here. Really the way that these insurance companies offer these indexed annuities and are able to make these things work is they're going out and taking their own dollars and buying large blocks of corporate bonds. And as you know, corporate bonds are tied to interest rates at the time of the purchase. Well, because it is a long-term product, in this case 10 years, if you were to not hold up your end of the agreement and exit the contract early, and the insurance company bought this large block of corporate bonds with a stated time frame that they have to hold them to maturity, and interest rates happen to increase or decrease, that can affect the purchase of those bonds and what they're worth at present day, the time you exit the contract early. So if interest rates rise, then the value of that corporate bond purchase is going to be worth less, and the insurance company would be accountable or held responsible for selling those bonds at a loss. And therefore, in order for them to pass that loss on to you because you're not holding up your end of the agreement, they have what's called a market value adjustment. Now, it also can work the other way. It doesn't always affect negatively. It could affect positively too. It is a fair playing field. So in the event, let's say, they bought a block of corporate bonds and the interest rates were high, and the interest rates over time lowered in the market. Well, now those bonds are worth more. So if you did exit early, they're going to pass on the growth or the benefit, the positive benefit of those bonds to you in the form of a market value adjustment as well. So it can be negative or positive. It's not just negative. So keep that in mind. Only happens and can happen during the first 10 years. After 10 years, you're free and clear of any market value adjustments or surrender charges for that matter. All right, let's talk about the interest crediting strategies on the indexed growth side. So with the Heritage Income Advantage, you have 7 index crediting options in the fixed account to diversify and grow your retirement income. You are not invested directly in any securities or stocks and are therefore protected for market downturns. Your account value can grow based on the interest earned from the fixed account option, the performance of the other indices, or a combination strategy. You may allocate to one or multiple index accounts, and you can reallocate your funds during the reallocation period before and after each contract anniversary. The index options give you the flexibility to choose annual point-to-point with participation rate, 2-year point-to-point with participation rate, annual point-to-point with cap rate, or annual monthly sum with cap rate. So I'll be breaking those things down here momentarily when we get into our software and look at the index crediting strategies and the back testing. So just stay tuned for that. Participation and cap rates are determined at contract issue and are guaranteed for that index crediting period. With any of the crediting strategy choices, you are guaranteed to never receive a negative credit. Work with your advisor to determine the strategy appropriate for your retirement goals. The initial premium plus premium bonus may be allocated among 8 available interest crediting options. Of course, they have the fixed account, which is guaranteed growth. Your funds grow at a fixed rate of compound interest. The rate is set annually and it's guaranteed to never be less than 1%. So it does have a guaranteed minimum fixed account of 1% in this product if you decide to allocate some monies towards that. And on the indexed accounts, they do offer growth potential and downturn protection. They include the S&P 500 annual point-to-point with cap, S&P 500 annual point-to-point with participation rate, S&P 500 annual monthly sum cap, S&P Mark V annual point-to-point with participation rate, the S&P Mark V 2-year point-to-point with participation rate, and the SG Intelligent Agile 6% volatility index annual point-to-point with participation rate, and the SG Intelligent Agile 6% VT index 2-year point-to-point with participation rate. Okay, so there's quite a few different strategies that are offered, which is very attractive in this particular annuity. So let's talk about participation rate. With a participation rate option, crediting is based on a percentage of the total index's performance over the index crediting period, 1 or 2 years. If the index performance is negative, 0% is credited. The participation rate is determined at contract issue and is guaranteed for the index crediting period chosen. The participation rate may change for any other period, but will never be less than the guaranteed minimum participation rate. So participation rate basically means of the index strategy's performance, whether it be a 1-year point-to-point strategy or 2-year point-to-point strategy, over that 1 or 2 years, how much of that index's performance do you participate in as the contract owner? So for example, if the participation rate was 50% and the index crediting strategy went up 10% in that 1 or 2 year period, you would receive 50% of that 10% growth credited to your account. In this case, that would equal 5%. Okay, so participation rate is how much do you participate in of the index strategy's growth for that 1 or 2 year period. There's also cap rates on certain select strategies. With a cap rate option, crediting is earned up to the cap rate percentage if the index performance is positive. If the index performance is negative, 0% is credited. The cap rate is determined at contract issue and is guaranteed for the index crediting period. The cap rate may change for any other period, but will never be less than the guaranteed minimum cap. So cap rate is exactly what it sounds like. There's a cap, there's a ceiling of the index's growth. If it's capped at 5%, but the index went up 10%, well, you're obviously just going to get 5% because that's the cap rate. If the cap rate was 5% and the index's growth was 4%, you're going to get the higher of the two, or the higher, you're only going to get up to the index's growth. So that would be 4% is what you would receive, even though the cap rate's 5. If the index was lesser than the cap rate, you're going to get the lesser of the two there. Hope that makes sense. Point to point. So what is a point to point option? It is the index performance and calculated based on 2 points, the beginning point and the ending point of the index crediting period. The interest is then credited to your contract based on the change in the index during that period, either using the participation rate or cap rate. These examples assume a participation rate of 50% and a cap rate of 5%. So point to point. On the date your annuity policy is issued, you're going to receive the binded policy, and it will state the beginning value, which is your starting point of the underlying index you're allocated to. Fast forward to a year later or 2 years, depending on which crediting period we are allocated to. The ending point will be the ending value on the anniversary, whether it be 1 year anniversary or 2 year anniversary. Your ending point will be the ending value of the index. So if the ending value is higher than the starting value, or the ending point is higher than the starting point, well, then you had positive growth. If it's lower, then you had negative growth, which in that case, you would always receive a 0 because you're contractually protected from market losses. But in this example, they do show on the left-hand side, index performance 12%. And on the annual point to point with a 5% cap rate, the amount that would be credited to the account would be 5% because of the 5% cap rate. On the annual point to point with 50% participation, because of it having a 50% participation rate, that would translate to half of the index's performance as an interest credit, and that would equal 6%. Very simple stuff there. They then show 4% index growth. Because of it being lesser than the cap, they would receive 4% as an interest credit. And then if it had a 50% participation, it would equal half, so 2%. And then they give an example of a negative performance. Obviously, you would then receive 0 on both of those types of strategies. Monthly sum is also an accrediting strategy that's available in this particular annuity. With a monthly sum option, crediting is based on index performance and is calculated based on the sum of 12 monthly percentage changes and subject to the cap rate. This example assumes a monthly sum cap rate of 1.5%. This particular strategy is not as common as a participation rate or a cap rate strategy, but it is still available, and we'll take a look at how it compares to the others involved in this annuity. But basically, with a monthly sum, they're going to look at every single month of the year and then calculate the sum and then determine what the average would be based on that formula. So for example, monthly returns, they're showing here every single month the actual return for 12 months, and then they receive the sum of the capped returns. So in this case, with the cap, there's a 3.5% or monthly sum cap of 1.5%. So you'll notice with each year, they're showing us what the cap is. So if the index went up 3% month 1, with the capped returns, you're getting a 1.5% credit. So they're taking every single month, applying the 1.5% cap if it was reached. If it was a negative amount, it does still apply, even though it doesn't directly impact your account value, but it is used to factor in the overall equation. And at the end of 12 months, after factoring in how many months you hit the cap, how many negative months there were, or if you didn't hit the cap, how much the growth was, and they figure out what the sum of the capped returns is. And that ends up being 3.5% in this example. And for year 2, they're actually showing some actual unfavorable returns every month, showing you that there is actually a negative 3% of sum of capped returns. But in this case, because you are contractually protected against loss, you would just receive a 0% index credit in that particular year. Okay, so we've gotten through the brochure. I hope you're still with me. That was a pretty lengthy brochure, but I do appreciate the thoroughness that Investors Heritage provided for the Heritage Income Advantage fixed indexed annuity. So if you're still with me, we're going to now dive into the software portion of our review, where we're going to take a deeper dive into the specific index crediting strategies that are offered in the Heritage Income Advantage annuity, and take them through what we call our back testing exercise. Now, this is a hypothetical example of how these products and how these specific index strategies could have performed if we owned them during the last 10 and 15 years. So this is listed in chronological order from highest to lowest in terms of highest average annualized rate of return using the 10-year column. So if you look to the right, you're going to see the 10, 15, and 20-year columns. This is from December 31st of 2010 to December 31st of 2020. And then the 15 years, December 31st of 05 to 2020, and 20 years is from 2000 to 2020. And it's going to list these index strategies according to highest to lowest from a hypothetical historical performance looking back over those periods of time. So we'll see the 2-year SG Intelligent 6% VT point-to-point with participation rate comes in as the strongest back-tested index option available in the Heritage Income Advantage. This particular strategy at the time of this review includes an 80% participation rate, and it's a 2-year point-to-point, so it's looking back over every 2 years is when the interest credit is applied. And based on that, over the last 10 years, this particular index option would have performed at a 5.29% average annualized rate of return. Now, just below that average annualized rate of return of 5.29%, you'll see a green and red number. And if you haven't done so already, you can enlarge your viewing window by clicking in the bottom right-hand portion of your screen. It should enlarge your viewing angle so you can see these numbers a little bit more accurately. But anyhow, you're going to see a green and red number just below that 5.29%. And what our software is designed to do is it looks back over the last 20-year period and identifies the best 10-year period and the worst performing 10-year period. So the green numbers indicating the best 10-year performance, and that happens to be from December 30th of 2009 to December 30th of 2019. And this particular index strategy would have performed at an average annualized rate of return of 6.04%. Looking at the red number, which is indicating the worst 10-year performance over the last 20 years, that happens to be from December 30th of 2005 to December 30th of 2015. And this performance, while still positive, even though it shows red just indicates the worst 10-year performance, it was 3.79% average annualized rate of return. Now, this is key here to understand that time frame was taking us through the global financial crisis of 2007 and 2008. And one of my philosophies on, deciding which annuity is right for you and what index strategy is the best for you is really to understand that we should be making our decision based on what the worst case scenario could be, not the best case. Everybody can show you these high rates of return, but we want to know what's the worst case scenario potentially, and what I could, possibly perform at. And in this case, taking us through a weaker time in our economy, taking us through that big market decline in 2007 and 2008, we know that this index strategy would have performed during that 10-year period of around 3.79%. Also, looking at the 15-year column, the average rate of return annualized is 4.34% using that same index strategy. We'll see that second option for the highest performing back-tested index is the S&P Mark V point-to-point. That's a 2-year strategy as well, using the participation rate of 80%. And we'll see the average annualized rate of return over the last 10 years at 4.01%, highest 10 at 4.42, and lowest 10 at 4.01. Coming in third is the 1-year SG Intelligent 6% VT point-to-point with participation rate. It's a 1-year crediting strategy, so every year you'll receive a credit. The participation rate is less. It goes from 80% in the 2-year version to 55% in the 1-year. And we'll notice with that participation rate being lessened, the average annualized rate of return when backtesting it over the last 10 years is 3.96%, highest 10, 4.46, lowest 10, 3.17, and 15 years at 3.54. I must make the disclaimer too that, prior performance is not always an indicator of future performance, but I do feel this information at least gives us an understanding of what these indexes could potentially do and the strategies associated with them, what they could potentially do moving forward if markets were to perform similarly to how they have in the past. Followed by the 1-year S&P Mark V, again, 55% participation on the 1-year strategy, 3.3% average over the last 10, 3.59, highest 10, 3.3, lowest 10. And then here's an example of the S&P 500 using that monthly sum cap. It's a 1-year point-to-point using the monthly sum cap. The cap is set at 1.25%. And we'll notice that those index strategies aren't very attractive, coming in at 2.48 average annual rate of return, highest 10, 2.48, lowest 10 at 1%. So that covers the index review and showing these different index crediting options available in the Heritage Income Advantage. We got a couple more things and then we'll wrap this review up. We're going to now take a look at the Guaranteed Income Calculator. So just bear with me. I'm going to go ahead and pull that up and then hopefully remember to share my screen again so you can actually see it with me. We're going to look in the state of Florida and look at a hypothetical example using a male age 60 and a spouse age 60, so it's joint income. And we're going to go ahead and take a look at that and defer it out a few different time frames to see how this thing would work. So hopefully you can see this. This is our Guaranteed Income Calculator. We have this sorted for state of Florida, which is our home state. Again, I work with clients in all 50 states. So if you're interested in working with me directly, I'd be honored to do that. You can visit our website at annuityassociation.com. Maybe you'd like to compare this annuity to some other options available on the market, see how it stacks up. Maybe you're thinking about rolling out an annuity and looking for a new alternative. If you'd like to do that comparison, I'd be happy to do that. Again, go to annuityassociation.com. Right there on the main page, click the green button to request your free report. In that report, you'll be taken to a series of opt-in questions. One of those being, would you like to be contacted by an advisor? Simply answer yes, and I will personally reach out to you in a timely fashion to see how I can help point you in the right direction. So here we are in the Guaranteed Income Calculator, looking at a joint income structure using a 60-year-old male and a 60-year-old spouse or female, $100,000 in premium investment. And then what we can do is defer the income stream up. We can slide this deferral bar up and down to see what the guaranteed income would be based on that age at the time we're turning it on. So let's just start out with assuming this couple's still working and maybe they're interested in turning on income when they retire at age 67 to supplement their Social Security income. So that would be deferring it for 7 years, turning income on contract year 8 at age 67. And then we'll see that annual lifetime income joint would be $8,238 based on that $100,000 premium investment. Now, here's a really cool thing about our calculator is it does break down how the income benefit is being calculated. If you remember back early on in our review, we broke down the T-chart exercise that covered how the benefit base grows. And the benefit base is going to grow first with an 8% income-based bonus being applied year one. So if you put $100,000 in year one, the benefit base is going to start out at $108,000. And then each year that you defer, the Heritage Income Advantage with the Guaranteed Lifetime Withdrawal Benefit Rider is going to grow that benefit base by 7% compounded roll-up rate, which is essentially an interest rate that's used to calculate the benefit base. So every year that you defer it, in this case, we're deferring it 7 years, the income value is growing by 7% compounded a year. And that's going to equal $173,424, which I've highlighted here on my screen with my mouse. That's the number of the benefit base has grown to over that 7-year deferral. Then, because of the joint lifetime income structure, the payout rate or the distribution rate is going to be 4.75%. That's locked in once you turn on the income stream. So that, if you take these two numbers, 173,424 multiplied by 4.75%, that's going to equate $8,238, which is the guaranteed lifetime annual income. Because it's structured joint, if one spouse passes away, the income will still continue on for the life of the surviving spouse. And then last but not least, because this annuity includes the enhanced income benefit rider at no additional charge, in the event we had a need for long-term care, the income benefit would double to $16,475 per year, as long as we meet the requirement of being unable to perform 2 out of the 6 activities of daily living. That benefit is paid for up to 5 years and covers both spouses. So, in the event you, have a long-term care event, maybe your spouse needs the long-term care and you're still around as well, but you don't need long-term care, the income will increase to $16,475 and pay out for up to 5 years. After 5 years, the income reverts back to the guaranteed annual lifetime income amount of $8,238 in this example. So I think this is a huge bonus, just an extra benefit. It's a great product to help you cover the needs for income as well as long-term care cost. And it should be definitely considered if those are some of your concerns. Now, this annuity can grow that roll-up amount, that roll-up benefit base up to 10 years. So every single year it can grow at 7% compounded every year you defer it for up to 10 years. Or up to age 85, depending on whichever comes first. So in this case, if they decided to defer it to age 70, the income would be increased to $10,623, and then the doubler on the enhanced income benefit would be $21,245 to cover the cost of care. So hope that makes sense for you there. Last but not least, let's go ahead and illustrate this guy and show you how it breaks down on a ledger. Nice thing about our software too is that we're able to really understand how to build the annuity using the different index allocation options available, and we can structure it whether we use one index option, we can diversify and use the top 2, but because of the back testing capabilities we have, we can identify which of those index strategies will be the best potentially the best moving forward based on those back test exercises. So in this case, we're going to show it using the top 2 to give us some diversification there. We're going to show it with the income benefit, and we're going to show it deferring for 10 years since that's the last example we looked at. And we're going to notice that using the last 10-year back test and projecting that moving forward on the index strategy, we're going to see the account value, which is the left-hand side of your T-chart if you are still with us from the beginning of this review where we broke down that exercise. We have our account value coming in. And then we have our benefit base, which is referred to as the income base over here, which is used to determine your lifetime income. So we'll notice after 10 years of deferral, the $100,000 after applying the 8% premium benefit bonus and the 7% guaranteed compounded roll-up rate every single year for 10 years, the benefit base has grown to $212,482. Multiply it by the 5% payout rate or lifetime withdrawal rate based on the age at the time the person's electing to turn on income for joint spouse. And then that'll equal $10,623 in lifetime withdrawal benefit. starting contract year 11 at age 70 for this couple. As you can see, that lifetime withdrawal rate, as I mentioned earlier in the review, in this particular product, it increases by 10 basis points every single year of deferral. In this example, it grows from 4.15% up to 5% year 10. And then once that income is turned on, that withdrawal rate is locked in and fixed moving forward. So that's going to really sum up this product from what's it called? Heritage Investors Heritage, excuse me. Sometimes I'm a little dyslexic, so I apologize for that. And this is their Heritage Income Advantage fixed indexed annuity, a great option for addressing long-term income and lifetime income streams for retirement, as well as mitigating the risk of long-term care costs because of the enhanced income benefit that's included at no additional charge with the Heritage Income Advantage Guaranteed Lifetime Withdrawal Benefit Rider. If you have any questions or you'd like to work with me directly, I'd be happy and honored to have that opportunity to work with you. I work with clients in all 50 states. I'm located in Florida, but we can utilize a Zoom meeting, a secure platform to see face-to-face using the video and internet connection. And if you'd like to do that, you can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report, and I will get that out to you in a timely fashion and give you a call to see how I can help point you in the right direction. So thanks so much for tuning in. If you've gotten some value out of this review, please give us a thumbs up or a like and share this video with some friends and family that also may get some value out of this. It does help our videos rank and get seen by more people across the country. So thanks so much for tuning in. Hope everybody has a great day. Take care of one another. This is Jeremiah Condra with AnnuityAssociation.com signing out.